On Friday, March 15th, 2013, ordinary people in Cyprus went to sleep, believing their life savings were protected by European Union banking regulations, insured by the same guarantees that protected deposits in Germany and France, backed by international treaties and legal frameworks that had stood for decades. And when they woke up on Saturday morning, they discovered that their government had agreed, under pressure from the European Central Bank and the International Monetary Fund, to confiscate between 6.7 and 9.9% of every bank deposit in the country, and the banks were closed, the ATMs were shut down, and there was nothing anyone could do about it. And this wasn't a third world country. This wasn't a banana republic. This was a member of the European Union, a modern developed nation with rule of law and property rights, and all the institutional protections that people assume make their money safe. And yet over a single weekend, the rules changed, the guarantees evaporated, and savings that people had spent lifetimes accumulating were simply taken. What happened in Cyprus isn't ancient history. It happened just over a decade ago, and it didn't happen because of war or revolution or some external catastrophe. It happened because of decisions made in conference rooms by officials in suits, decisions justified with technical economic language, decisions presented as unfortunate but necessary. And if you think this could never happen in the United States, if you believe that American institutions are somehow immune to the same pressures that forced Cyprus to confiscate deposits, then you need to understand something fundamental about how modern financial systems operate under stress, which is that every protection you assume is absolute is actually conditional. Every guarantee you trust is contingent on circumstances remaining stable, and stability, as Cyprus demonstrated with brutal clarity, can disappear faster than you can react. Let me walk you through exactly what happened in Cyprus step by step, because the details matter, because understanding the mechanism is the only way to recognize when the same mechanism might be applied elsewhere. And I want you to pay attention not just to what happened, but to how it was justified, how it was implemented, how people responded, and most importantly, how the international financial system treated this confiscation as a legitimate policy tool rather than as theft, because that normalization, that acceptance of deposit confiscation as reasonable crisis management, that's what should terrify anyone with savings in a bank anywhere in the developed world. Cyprus is a small island nation in the Mediterranean, population just over 1 million, and by the early 2000s it had developed an outsized banking sector, with deposits totaling roughly 8 times the country's annual economic output, and much of this money came from foreign depositors, particularly Russians, who were attracted by low taxes and light regulation, but plenty of it belonged to ordinary Cypriot citizens, small business owners, retirees, families who had saved for generations, and these people trusted that their deposits were safe because Cyprus was part of the European Union, because their accounts were supposedly insured up to 100,000 euros, because they had been told repeatedly by authorities that the banking system was sound and their money was protected. But behind the facade of stability, Cyprus banks had made terrible decisions. They had invested heavily in Greek government bonds, and when Greece went through its debt crisis and those bonds lost most of their value, the Cyprus banks became insolvent. They had liabilities that exceeded their assets, and normally when a bank becomes insolvent it fails and depositors lose their money. But in the modern system, banks are considered too important to fail. So instead of failure, there's rescue. And rescue requires money, and the question becomes, where does that money come from? And in Cyprus the answer was, from the depositors themselves. The European Central Bank and the International Monetary Fund offered Cyprus a bailout, but they attached conditions, and the primary condition was that Cyprus had to raise 5.8 billion euros from somewhere to contribute to the rescue package, and after negotiations that took place largely in secret, largely over that single weekend in March, the Cyprus government agreed to impose a levy on bank deposits, a one-time confiscation that would take 6.75% from deposits under 100,000 euros and 9.9% from deposits above that threshold. And this decision was announced on Saturday morning while the banks were closed. And when people tried to withdraw their money, they discovered they couldn't because the banks stayed closed, not just for that weekend, but for nearly 2 weeks. And when they finally reopened, capital controls were in place that severely restricted how much money people could access. how much they could transfer, what they could do with their own savings. Now I want you to think about what this means from the perspective of an ordinary depositor, someone who had followed all the rules, who had saved diligently, who had trusted the system. Imagine waking up on Saturday morning and learning that the government and international institutions had decided overnight to take nearly 10% of everything you had saved, without your consent, without warning, without any democratic process. And imagine being told that this was legal, that it was necessary, that it was the only way to save the banking system. And imagine having no recourse, no appeal, no way to protect yourself, because by the time you learned about it, the decision had already been made, and the mechanisms to prevent you from moving your money had already been activated. The public reaction in Cyprus was explosive. People protested in the streets. They surrounded the parliament building. They withdrew every cent they could once the banks reopened with restrictions. They lost faith, not just in the banking system, but in the entire institutional framework that had claimed to protect them. But the protests didn't matter. The anger didn't matter, because the decision had been made at a level beyond democratic accountability, at the level of international financial institutions and European Union technocrats who believed, probably sincerely, that confiscating deposits was a reasonable price to pay for preventing a complete banking system collapse. And here's where the story becomes directly relevant to anyone watching this in the United States, because the policy framework used in Cyprus, the legal mechanism called a bail-in, wasn't invented in Cyprus. It was developed in international forums over several years after the 2008 financial crisis, developed specifically as an alternative to using taxpayer money for bank bailouts, and this framework has been incorporated into banking regulations around the world, including in the United States, through the Dodd-Frank Act's Orderly Liquidation Authority. And while the specific percentages and thresholds might differ, while the implementation might be more sophisticated, the core principle is identical. When banks fail, depositors and creditors can be forced to absorb losses to recapitalize the institution. If this is making you fundamentally reconsider what it means to have money in a bank, if you're starting to understand that the safety you assumed was guaranteed is actually contingent on decisions made by authorities during crises, then you're beginning to see why this channel exists, why understanding these mechanisms isn't optional if you want to protect what you've built over a lifetime. And if you haven't subscribed yet, if you're watching this video without being subscribed, then you need to understand something. The information we're providing here isn't available in mainstream financial media. It's not discussed by advisors who profit from keeping you invested in the system. It's the uncomfortable truth that institutions don't want widely known, and missing the next video in this series could mean missing the specific information you need to protect yourself. So subscribe now, turn on notifications, and commit to understanding how the system actually works rather than how you wish it worked. Now let me show you how the Cyprus situation connects to broader patterns in monetary history, because what happened there wasn't unprecedented. It was just the most recent and most visible example of a mechanism that appears repeatedly throughout financial crises. The mechanism where authorities decide that protecting institutional stability requires sacrificing individual property rights. And this trade-off, this decision to prioritize the system over the people within it, this is a feature, not a bug. This is how the system is designed to operate under stress, and recognizing this design is essential to understanding your actual level of risk. Go back to the banking crises of the early 1930s in the United States, when thousands of banks failed and millions of depositors lost their savings, and the government response wasn't to make depositors whole. It wasn't to punish the bankers who had made reckless loans. It was to close all the banks simultaneously through a bank holiday, to prevent people from accessing their own money, until authorities decided which institutions would survive and which wouldn't. And when the banks reopened, many deposits had simply vanished, and depositors had no legal recourse because they were unsecured creditors. And this established the principle that your bank deposit isn't really your property. It's a loan you've made to the bank, and loans carry risk. And when banks fail, creditors lose money, and the law considers this normal and acceptable. Or look at what happened in Argentina in 2001, when the government, facing a currency crisis and banking panic, imposed what they called the corralito, which restricted how much money people could withdraw from their banks, limiting them to small amounts per week. And these restrictions lasted for months, and during that time the currency was devalued, which meant that when people finally got access to their money, it was worth a fraction of what it had been. And this combination of capital controls and currency devaluation effectively confiscated most of the purchasing power of people's savings, and it was all done legally, under emergency powers, with the justification that it was necessary to prevent economic collapse. The pattern across Cyprus and Argentina and the United States in the 1930s is identical. When the financial system faces existential pressure, authorities activate legal mechanisms that override normal property rights, and they justify this by claiming that individual losses are acceptable if they prevent systemic collapse, and they implement it quickly, usually over a weekend or during a declared emergency, when normal democratic processes are suspended. And by the time people understand what's happened, the mechanisms to protect their money have already been disabled. And here's what makes this particularly relevant right now, at this specific moment in history. And I want to be very clear that I'm not predicting this will happen in the United States. I'm observing that the structural conditions that preceded crises in other countries, the high debt levels, the banking sector fragility, the political dysfunction, the erosion of institutional credibility, these conditions exist in the United States today at levels that would have seemed impossible a generation ago, and the legal frameworks for bail-ins, for capital controls, for emergency restrictions on withdrawals, these frameworks exist in current law. They're not theoretical. They're documented in Federal Deposit Insurance Corporation resolution plans, in Dodd-Frank provisions, in presidential emergency economic powers that can be activated with a stroke of a pen. The United States federal debt exceeds $35 trillion. The banking system holds trillions in assets that are marked at values that assume stable interest rates and economic conditions. The pension system is underfunded by trillions. The Social Security Trust Fund is projected to be depleted within a decade, and all of this exists within a global financial system that's more interconnected and more leveraged than at any point in history. And I'm not saying collapse is imminent. I'm saying that the structural vulnerabilities exist, and when vulnerabilities exist, crises eventually materialize. And when crises materialize, the mechanisms we've been discussing get activated, and the people who understand this in advance are the ones who can position themselves to survive with their wealth intact. Now let me tell you what happened to specific people in Cyprus, because statistics don't convey human impact, but stories do. And there was a couple, both in their 70s, who had sold their home and had the proceeds, roughly €300,000, in the bank while they searched for a smaller place to retire. And when the bail-in was announced, they lost nearly €30,000 overnight. And that money represented years of their lives, represented security they had planned carefully to achieve, and it was simply gone, taken by authorities who decided that their property rights were less important than stabilizing banks that had made reckless investments. And when they tried to withdraw the remaining money after the banks reopened, they faced severe restrictions. They could only access small amounts. They couldn't transfer money abroad. They were effectively trapped in a system that had already robbed them and now controlled their access to what remained. Or consider the small business owners who had operating capital in the banks, money they needed to pay employees, to purchase inventory, to meet obligations. And suddenly that capital was reduced by 10%, and what remained was locked behind capital controls that made normal business operations impossible. And many of these businesses failed, not because they were poorly managed, but because the banking system failure destroyed their liquidity, and the owners lost not just their savings, but their livelihoods. And there was no compensation, no apology, no acknowledgement that anything unjust had occurred, because from the system's perspective, these were acceptable casualties in the effort to prevent something worse. And I want you to imagine yourself in that situation. Imagine that you've worked your entire life, that you've saved carefully, that you've followed every rule, that you've trusted the institutions that promised to protect you. And imagine learning over a weekend that those institutions have decided your savings are available to be confiscated, that the guarantees you relied on were conditional, that your property rights yield to systemic necessity. And imagine having no way to fight back, no way to recover what was taken, no political recourse because the decision was made by international bodies beyond the reach of democratic accountability. And then ask yourself whether you're comfortable maintaining your entire life savings in a system where this is legally possible, where the precedent has been established, where the mechanisms exist in law, waiting to be activated the next time authorities decide it's necessary. Now here's what the financial establishment will tell you. When you raise these concerns, they'll say that Cyprus was unique, that it had an unusually large banking sector relative to its economy, that it had attracted questionable foreign deposits, that the situation was extraordinary and doesn't apply to larger, more stable countries like the United States. And there's some truth in those arguments. Cyprus did have specific vulnerabilities. But what those arguments ignore is that every crisis is unique in its details while being identical in its structure, and the structure is always the same: excessive debt, institutional fragility, political pressure, and then a decision point where authorities choose between protecting individual rights and protecting systemic stability, and they always choose systemic stability, and they always find legal justifications, and they always implement it quickly before people can react. The legal framework for bail-ins exists in United States law right now. It was put there deliberately after 2008. It's been discussed in Federal Reserve papers and FDIC planning documents, and while nobody can predict exactly when or how it might be used, the fact that it exists, the fact that Cyprus demonstrated its practical application, the fact that international financial institutions treated the Cyprus bail-in as a successful template rather than as theft, all of this should inform how you think about concentration risk, about where you hold your savings, about the difference between direct ownership and mediated ownership, about the importance of diversification not just across asset classes, but across institutional and jurisdictional boundaries. And this brings us to the question that I know many of you are asking, which is what specifically should you do with this information? And that's a question I can't answer for you because everyone's situation is different. Everyone has different resources and obligations and risk tolerances, but what I can tell you is that understanding is the prerequisite for action, that you can't protect yourself from risks you don't know exist, that the people who got destroyed in Cyprus were the ones who trusted blindly, while the people who preserved their wealth were the ones who understood that guarantees are conditional and acted accordingly. I want you to think carefully about where your retirement savings are held, about whether you understand the legal terms under which you hold them, about what restrictions exist on accessing them, about what emergency powers could be invoked to limit or redirect them. And I want you to ask yourself whether you're comfortable with your level of institutional dependence, whether you've thought through scenarios where access to your savings gets restricted, where the value gets reduced through bail-ins or inflation or forced conversions, where the rules change faster than you can react. And if you haven't thought through these scenarios, if you're operating on assumptions inherited from a different era, then you're more vulnerable than you realize. And I want you to leave a comment telling me whether you were aware of what happened in Cyprus before watching this video, whether this changes how you think about banking system safety, whether you see parallels between the conditions that led to the Cyprus crisis and conditions that exist today, because these conversations matter, because collective awareness creates pressure for transparency, because the more people who understand these mechanisms, the harder it becomes for institutions to implement them quietly. And while that won't prevent crises, it does create more accountability, more visibility, more pressure for solutions that don't sacrifice individual savers to protect institutional interests. If this video has fundamentally changed how you understand banking system safety, if you now see that the protections you assumed were absolute are actually conditional, if you recognize that what happened in Cyprus could happen anywhere under sufficient pressure because the legal frameworks exist and the precedent has been established, then you need to do 3 things right now. First, hit the like button so the algorithm shows this to more people who need to see it, because this information is too important to remain hidden. Second, subscribe and turn on all notifications so you don't miss the next video where we're going to examine the specific legal language in United States banking law that enables bail-ins and show you exactly what your deposit agreement actually says about your rights during resolution procedures. And third, share this video with anyone you know who has significant savings in banks, anyone approaching retirement, anyone who trusts the system without understanding its legal architecture, because the gap between what people assume about safety and what's legally possible is dangerously wide, and closing that gap through education is the only protection that can't be confiscated. The next video is going to show you something even more disturbing, We're going to examine what happened to retirement accounts and pension funds in countries that experienced currency crises. We're going to show you the specific mechanisms that were used to redirect or confiscate or devalue retirement savings, and we're going to compare those mechanisms to provisions that exist in United States law right now, in ERISA regulations, in IRS rules about required minimum distributions, in emergency economic powers that can modify tax treatment retroactively, and once you see how retirement accounts can be targeted during fiscal crises, once you understand that your IRA or 401k exists within a legal framework that gives authorities extraordinary flexibility during emergencies, you'll never think about retirement security the same way again. So make sure you're subscribed, make sure you're prepared to have more assumptions challenged, and I'll see you in that next video, where we continue documenting the mechanisms of financial power that everyone needs to understand, but almost nobody is explaining.